We sort of know what a transaction is, but what is a transaction? How would you describe it? Yes.
Transaction.
What is a transaction?
Isn't that an exchange of something like between a currency for a good or vice versa?
Yeah. An exchange of something. You want to ask something?
No, I just
No?
read the definition that you have up.
Sorry, I shouldn't put it up. No, it doesn't really say here what my definition is in the chapter, but it's not in the activity because Karen wrote the activity. I wrote the chapter. A transaction involves an exchange, like David said. It's some kind of trade. So you give something up and you receive something in return. That's what a transaction is. So that means that a transaction has to have two pieces to it. Because as a business, you never give something away for free. And you never receive something for free. There's always another side of it. So a transaction always has this give and take, and it's going to affect the accounts always. You can underline the word always in two ways. And that's the fundamental idea behind accounting record keeping, is that in a transaction is going to affect the financial statements in two ways, always. So it's like that student rule, you know, like when you see the word always, then the answer must be false. Whenever you see always and never, it must be false. But if I give you a true-false question, right? I don't like true-false. But I gave it to you and say, a transaction always affects the financial statements in at least two ways, true or false. The answer is true. It's going to affect assets, liabilities, and/or stockholders' equity. And we know the accounting equation already, assets equals liabilities plus stockholders' equity. So that's a fundamental idea behind what transactions are. And let's just walk through this together, because it's just sort of an introductory thing. A transaction affects, okay, a company is not liable for payment of supplies until the supplies are they ordered or arrived? When does a company become liable for payment? When the supplies arrive. So it's very interesting. A transaction, ordering goods from a company is not a transaction. Hiring an employee is not a transaction. Paying an employee or having an employee work for you with the understanding that they're going to pay you is a transaction. So when my dean said to me, teach this class, actually I said to myself, teach this class, that was a transaction because I agreed to teach the class and the university agreed to pay me X number of dollars. That's a transaction because there's something going on each side. But an order itself is not a transaction because no one is committed to doing anything yet. So therefore, it's not recorded. We only record transactions. Now, when the goods arrive, that's going to increase an asset. If we were to look at this equation here, I'm going to insert it right here. So if you were to receive supplies, you're going to have more inventory, and under liabilities, you're going to have more accounts payable because now you owe money for the supplies. Because the arrival of supplies increases an asset and creates a liability, this event is a transaction, and it is recorded. So just ordering supplies doesn't do anything. But receiving the supplies creates the liability. Now, there may be situations when you make an order and that commits you to purchasing it, in which case it would be a transaction. So because a transaction consists of give and take, at least how many accounts are always affected? 2. And therefore, this is called, it's not called double entry accounting. And the history of double entry accounting, accounting was invented, you should know, in the 1400s. It was an extension of mathematics. It was part of the Italian Renaissance. Basically what happened in the 1400s, Italy, they were trying to find better ways to keep shipping records. So the double entry accounting system, which is very, very similar to what we use today, was invented at that time, and we pretty much do it the same way. I mean, we do it with computers now. The format is a little different, but the basic idea of double entry accounting comes from there. Investors contribute $30,000 in cash in exchange for common stock. Is that a transaction? It is. What accounts are affected? Cash or accounts receivable? Well, don't even look at this. What accounts are going to be affected when investors contribute $30,000 of cash to buy common stock? Gesundheit. So one account would be, let's put it over here, okay? Investors contribute $30,000. We're going to do this whole thing more formally in cash for stock. So one account that's going to be affected is going to be stockholders' equity or common stock, right, as part of contributed capital. What's another account that would be affected here? Cash, which is an asset. So the transaction affects cash and common stock. Cash is what? Asset, liability, stockholders' equity. Asset, which is going to increase or decrease? Increase. And common stock is a stockholders' equity account that is also going to, increase by $30,000. So you can see here that this balance of assets equals liabilities plus stockholders' equity is always going to be maintained. If you're going to increase one, because it always has to be equal, right? So cash increases on one side, then common stock increases on the other. Now you can see on the next page a little bit about what we're doing here. I have on the next page assets set up in the first 2 columns. I have liabilities in the 3rd column, and I have stockholders' equity in the 4th and 5th columns. So if the company received $30,000 in cash in exchange for common stock, then you would increase cash by $30,000 and you would increase common stock by $30,000. And your balance of assets equals liabilities is going to be maintained. Now, what happens with revenues, expenses, and dividends is going to be a little different. Because if you remember, we said, let me make this a little larger. I wish I had my pen. We said that beginning retained earnings plus net income minus dividends equals ending retained earnings. Remember that? That's the formula for retained earnings. But where does net income come from? We said that revenues minus expenses equals net income. So this is where net income comes from. And if you want, you could do a little algebra if it doesn't scare you too much. You could do a little algebra and substitution, right? What you could say is here that, is you could just substitute revenues and expenses instead of net income. So you could say that revenue increases retained earnings and expenses decreases retained earnings.